I want to start today by connecting some dots that should terrify every investor watching this. In my last two videos, I showed you something remarkable. First, OpenAI is burning through $12 billion every single quarter. Not every year, every quarter. Second, Google's search monopoly, untouchable for 2 decades, is cracking for the first time as ChatGPT steals 9% of search queries. But here's what I didn't tell you. Those aren't isolated events. They're symptoms of something much bigger, something that could reshape your entire portfolio, your retirement, everything you've built. The Magnificent Seven, Apple, Microsoft, Google, Amazon, Meta, Nvidia, and Tesla now control 37% of the S&P 500. Let me say that number again because it's staggering. 37%. That's $21 trillion in market capitalization concentrated in just 7 companies. Back in 2015, these same companies represented only 12% of the index. In a single decade, they've tripled their dominance. And every single one of them is making the exact same bet. Artificial intelligence. Now here's where it gets interesting. These companies are spending more on AI infrastructure this year than the entire GDP of Sweden. Microsoft, Google, Amazon, and Meta will collectively invest $380 billion in 2025 alone, building data centers that may sit largely empty for years. Does that sound familiar? Because the last time technology companies spent this much building infrastructure that had no immediate users, it was 1999. We called it the dot-com bubble, and we all remember how that ended. Trillions of dollars evaporated, retirement accounts destroyed. Companies that were worth billions went to zero overnight. So today I'm going to answer the question every investor is asking, but most are too afraid to confront. Are we in an AI bubble? And more importantly, if we are, what the hell do you do about it? Let's start with the concentration crisis, because this is where the real danger lives. The Magnificent Seven now represent somewhere between 35 and 37% of the S&P 500 as of November 2025. To put that in perspective, their combined market capitalization is $21.2 trillion. That's 16% of all global stocks concentrated in just 7 American technology companies. From 2015 to 2024, while the S&P 500 returned a respectable 178%, the Magnificent Seven returned 697%, nearly 4 times the broader market. But here's what most people forget. In 2022, during the bear market, when the S&P fell 20%, the Magnificent Seven fell 41%. They're twice as volatile on the downside. Let me break down each of these 7 companies so you understand what you're actually invested in. Nvidia, valued at $4.5 trillion, is the AI chip king. Their PE ratio sits at 44 right now, which sounds reasonable until you realize their 3-year average was 7.8. The forward PE is about 30, which means Wall Street is expecting absolutely massive earnings growth. Through September 2025, Nvidia alone contributed 20% of the S&P 500's total return. Think about that. One company, responsible for 1/5 of the entire index's gains, they control 94.6% of the AI data center GPU market. But here's their problem. They're essentially a one-product company in one product cycle. If AI spending slows, or if China export restrictions tighten further, Nvidia doesn't just decline, it collapses. Microsoft, now worth over $4 trillion, has a PE ratio of about 35. Azure Cloud is growing at 31%, driven by AI demand. But here's what should worry you. Their fiscal year 2026 capital expenditures are $94 billion, up 58% year over year. That's not sustainable growth, that's panic spending. And their partnership with OpenAI has them committed to $250 billion in future Azure commitments. Meanwhile, they're losing $12 billion per quarter on their 27% stake in OpenAI. That's not a typo. $12 billion per quarter. Apple, at $3.6 trillion, has a PPE between 34 and 36. But here's their dirty secret. 48% of the revenue still comes from iPhone sales. They're late to the AI party, playing desperate catch-up, and unlike the others, they're only spending 11 to 12 billion on capital expenditures because they outsource infrastructure. Their AI features keep getting delayed, and Siri is still the worst voice assistant on the market. They're the most vulnerable of the 7 to an AI-driven disruption. Alphabet, Google's parent company, is worth over $3 trillion with a PE of about 29. They're spending $91 to $93 billion on capital expenditures in 2025, up from initial guidance of 75 to 85 billion. They raised spending mid-year because they're panicking. Their search business still commands 89% market share, but as we covered in my previous video, ChatGPT is taking 9% of queries and growing. When your monopoly starts cracking after 20 years, you spend whatever it takes to defend it. Amazon, worth over $2 trillion, is committing $125 billion to capital expenditures in 2025. AWS is second in cloud but growing slower than Microsoft's Azure. And here's the kicker. They've openly stated that the vast majority of their capital spending is on AI infrastructure with an unclear timeline for return on investment. They're building first and figuring out the business model later. Meta, valued at $1.5 trillion, has the lowest PE ratio of the group. but they're spending $70 to $72 billion on capital expenditures in 2025. Unlike the others, Meta has no cloud business, which means they have no business-to-business revenue stream to monetize their AI spending. They're betting entirely on better ad targeting and new consumer products that don't exist yet. In October 2025, their stock dropped 11% in a single day when investors realized how much they're spending with no clear path to return. It was a warning shot. Tesla, worth over $1 trillion, is the most volatile of the seven. Their entire AI bet rests on full self-driving and robotics. But they're facing intensifying EV competition, and full self-driving still isn't actually full self-driving. It's the most speculative of the Magnificent Seven, priced for a future that keeps not arriving. Now let me give you the math that should absolutely terrify you. At the peak of the dot-com bubble, the top 10 companies represented about 25% of the S&P 500. Today, just 7 companies represent 37%. But here's the statistic that should keep you up at night. 75% of all S&P 500 gains since October 2022 have come from just these 7 stocks. That means 493 companies in the index, the vast majority, are basically treading water while these 7 carry everything. There's no diversification benefit anymore. When you buy an S&P 500 index fund thinking you're diversified, you're actually putting 37% of your money into 7 technology companies making the same AI bet. When they fall, and history suggests they will, everything falls. This is the very definition of concentration risk. And concentration risk is exactly what destroys portfolios when bubbles pop. Now let's talk about the AI spending arms race, because the numbers are so large they become almost meaningless until you put them in context. Microsoft is spending $120 billion in their current fiscal year. Amazon is spending $125 billion, up from $83 billion in 2024. Alphabet is spending $91 to $93 billion, up from their initial guidance of $75 billion. Meta is spending $70 to $72 billion. Just these 4 companies alone are spending over $380 billion on AI infrastructure in a single year. To put that in perspective, that's roughly 1% of the entire United States GDP. It exceeds the inflation-adjusted cost of the Manhattan Project. It exceeds the Apollo project at peak spending. It rivals the dot-com era broadband build-out at its absolute peak. The only historical comparison that comes close is the railroad investments of the 1880s, which represented about 6% of the economy at the time. Where is this money actually going? About 60% goes to servers and GPUs, which is Nvidia's golden age. 40% goes to data centers and networking infrastructure. Amazon alone is adding 1 gigawatt of power capacity in the 4th quarter, and they're planning to double their 2022 power capacity by 2027. These aren't incremental investments. This is nation-state level infrastructure spending by private companies. But here's the fundamental business model problem that nobody wants to talk about. Big tech is spending $400 billion per year on AI infrastructure. Meanwhile, OpenAI, the largest and most successful AI company, is projected to make $13 billion in revenue for 2025, and they're losing $12 billion per quarter. Let me say that again slower. The entire AI industry is spending $400 billion per year on infrastructure. The largest AI company is making $13 billion in revenue and losing over $12 billion every single quarter. The math doesn't math. At these spending levels, AI companies would need to generate hundreds of billions in revenue just to break even on the infrastructure investments. We're not even remotely close to that. The Microsoft OpenAI situation is the canary in the coal mine. Microsoft owns 27% of OpenAI after the recent restructuring. In Q3 2025, Microsoft reported a $3.1 billion loss from their OpenAI investment. If Microsoft owns 27% and lost $3.1 billion, that translates to OpenAI losing approximately $11.5 billion in Q3 alone. In the first half of 2025, OpenAI lost $13.5 billion total. So we're looking at approximately $24 to $25 billion in losses for just the first 9 months of 2025. Now here's where it gets truly insane. OpenAI is projecting they'll generate $13 billion in revenue in 2025, but won't be cash flow positive until 2029 or 2030. They're projecting cumulative losses through 2029 of $115 billion, and their revenue projection for 2030 is $200 billion. That means they need to go from $13 billion in revenue to $200 billion in just 5 years. That's 15 times growth. That has never happened in the history of technology. Not with the iPhone, which had carrier subsidies. Not with social media, which was free and viral. Not with anything. And yet Microsoft, Google, and Amazon are betting hundreds of billions of dollars that this growth will somehow materialize. Let's talk about where this infrastructure money is actually going, because the scale is difficult to comprehend. Nvidia GPUs cost $30,000 to $50,000 each, and you need millions of them. Companies are also developing custom AI chips, like Google's TPUs, Amazon's Trainium, and Microsoft's custom silicon to reduce dependence on Nvidia. Each data center costs billions to build. The AI data centers require nuclear power plant levels of energy. They need sophisticated liquid cooling systems for high-density compute. They need high-speed interconnects between GPUs that cost fortunes. OpenAI's commitments alone are staggering. They have $1.4 trillion in commitments over the next 8 years. That includes a $500 billion Stargate project and multiple deals with Oracle totaling hundreds of billions. 1 gigawatt of data center capacity costs roughly $50 billion to build. OpenAI is planning to build 30 gigawatts of capacity. The total estimated cost is $1.5 trillion. Let me make this meaningful for you. The entire market capitalization of OpenAI is $500 billion. They're committing to spending $1.5 trillion on infrastructure. That's 3 times their total valuation. They're betting their entire company, and 3 times over, on a future that may never arrive. Now let's talk about the dot-com parallels, because the people who lived through that era are sounding alarm bells that most investors are ignoring. Apollo's chief economist Torsten Sluck has said that the top 10 companies in the S&P 500 today are more overvalued than they were in the 1990s. He's calling the AI bubble bigger than the dot-com bubble. The Magnificent Seven are trading at 31 times forward earnings versus the remaining 493 companies at 20 times forward earnings. That's a massive valuation gap. Analyst Julian Guerin from MacroStrategy Partnership has called this the biggest and most dangerous bubble the world has ever seen. He claims the AI bubble is 17 times bigger than the dot-com bubble and 4 times bigger than the 2008 real estate bubble. He's calling it a fundamental misallocation of capital in the United States. Albert Edwards from Societe Generale, who correctly called the dot-com bubble, says the AI bubble is worse than 2008. His quote is chilling. He says people just don't want to listen because they're making so much money. That's exactly what people said in 1999. Even the IMF's chief economist Pierre-Olivier Gourinchas has warned that the AI investment boom could burst like the dot-com bubble, though he believes it's less likely to create a systemic crisis like 2008 because the underlying companies are profitable. But he acknowledges the similar dynamics of high valuations and capital gains fueling consumption. And here's the kicker. Even Sam Altman, the CEO of OpenAI, the man with the most to gain from AI hype, has admitted we're in a bubble. In his own words, he said, "Are we in a phase where investors as a whole are overexcited about AI?" My opinion is yes. He compared it directly to dot-com bubble dynamics, saying when bubbles happen, smart people get overexcited about a kernel of truth. When the guy whose company is at the center of the AI boom is telling you it's a bubble, maybe you should listen. The historical parallel that haunts me is the fiber optic cable build-out of the late 1990s. Companies like Global Crossing, Level 3, and Quest spent hundreds of billions of dollars building massive fiber optic networks, anticipating internet traffic demand that never came, or at least didn't come for another decade. The result was that 85 to 95% of all fiber laid in the 1990s remained unused. They called it dark fiber. Corning stock went from $100 in 2000 to $1 in 2002, a 99% crash. Ciena's revenue collapsed from $1.6 billion to $300 million overnight, an 81% drop, and their stock fell 98%. These companies built the infrastructure for a future that eventually arrived, but they went bankrupt before that future materialized. The parallel today is unmistakable. In the 1990s, telecom companies built infrastructure for internet traffic that wouldn't exist for another decade. Today, AI companies are building data centers for AI workloads that don't exist yet. Mark Zuckerberg announced plans for an AI data center so large it could cover a significant part of Manhattan. Do we have AI applications today that require a data center the size of Manhattan? No, but they're building it anyway, betting that the applications will come. That's not business planning, that's religion. But I want to be intellectually honest here because there are key differences between today and the dot-com era that suggest this time might actually be different. First, the dot-com companies had no revenue and were pure speculation. Today's Magnificent Seven generate over $1 trillion in combined revenue. They're profitable businesses funding their AI bets from their own cash flows, not relying on capital markets like the dot-com companies that died the moment funding dried up. Second, we have actual product market fit this time. ChatGPT has 800 million weekly users. That's real adoption, not vaporware. Cloud services are a proven $500 billion market. Enterprise AI is showing real productivity gains that can be measured. This isn't like Pets.com promising to revolutionize pet food delivery with no actual plan. Third, these companies are self-funding with positive free cash flow. The hyperscalers can fund AI infrastructure from their operations. When the dot-com bubble popped, companies that required constant fundraising died immediately. These companies won't go bankrupt even if AI completely disappoints. Fourth, the Magnificent Seven own the distribution channels. They control the phones, the browsers, the clouds, the operating systems. They can push AI features to billions of users instantly. .com companies had no distribution and had to spend fortunes on Super Bowl ads just to get noticed. But here's the catch that everyone's missing. Yes, these companies are profitable now. Yes, they have real businesses. But they're spending so much on AI that they're destroying their own margins. Meta's operating margin is getting compressed. Microsoft's free cash flow is shrinking relative to their investments. And for what? An AI future that might take a decade to monetize, if it ever does. Let me talk about the monetization mirage, because this is where the entire thesis falls apart. OpenAI has 800 million weekly ChatGPT users. That sounds impressive until you realize that only 5% of them pay for the service. That's 40 million paying users. 95% use it completely free. The revenue per user works out to roughly $16 per year total. Compare that to Netflix at $200 per user per year or Spotify at $80 per user per year. The monetization is terrible. This isn't just an OpenAI problem. A Menlo Ventures study found that only 3% of consumers are willing to pay for AI services. McKinsey released a report in June 2025 showing that 8 out of 10 companies implementing AI report no substantial profit increases. Why? Because integration is complex, ROI is hard to measure, and AI disrupts existing workflows more than it enhances them. The enterprise market is supposed to be the salvation. Microsoft Copilot charges $30 per user per month for Office integration, but adoption is slow because companies are reluctant to pay that premium when the productivity gains are unclear. Google Workspace AI has similar pricing and similar adoption issues. ChatGPT Enterprise is getting some traction, but the numbers are still small relative to the infrastructure investments. Then there's the cost structure problem. Running AI is expensive. A single ChatGPT query costs 10 times more than a Google search. Sam Altman has openly admitted they're losing money on the $200 per month ChatGPT Pro subscription. Think about that. Their highest tier paying customers are unprofitable. Why? Because the compute costs exceed the revenue. The more users they get, the more money they lose. OpenAI's path to profitability requires them to lose $44 billion cumulatively through 2029, then somehow grow revenue from $13 billion in 2025 to $200 billion in 2030. That's 15 times growth. The iPhone had carrier subsidies, where carriers would pay $200 to $300 per phone to lock customers into contracts. AI has no subsidy model. Users expect AI to be free because Google trained an entire generation that search is free. The willingness to pay is very, very low. Meta has a unique problem. They're spending $70 billion on AI infrastructure, but they have no cloud business to monetize it through. They're betting entirely on better ad targeting and hypothetical new products. When they reported earnings showing the spending, the stock dropped 11% in a single day. Oppenheimer downgraded them specifically citing an unknown revenue opportunity. The market is starting to lose patience. An MIT study found that 95% of AI pilot projects fail to yield meaningful results. Over $40 billion has been invested in generative AI, and there's a massive disconnect between investment and returns. Companies simply can't figure out how to integrate AI effectively into their workflows. This is the quiet crisis in AI. Everyone's talking about the technology. No one's talking about the fact that most companies can't figure out how to actually use it productively. It's like we've built a massive infrastructure for electric cars, but no one knows how to drive. Now let's talk about the demand mirage. Every tech CEO is telling the same story. Andy Jassy from Amazon calls it a once-in-a-lifetime type of business opportunity. Satya Nadella from Microsoft says there are infrastructure shortages and they can't keep up with AI demand. Sundar Pichai from Google says he's worried about being supply constrained. Mark Zuckerberg says 2025 is the defining year for AI. They're all saying demand is insatiable, unlimited, unprecedented. But look at the actual numbers. Azure grew 31% in Q3 2025. That's strong growth, but it's not 300% growth. AWS is growing slower than Azure. Google Cloud is the slowest of the big three and actually missed analyst estimates. All three companies cited capacity constraints holding back growth. Now wait, let me get this straight. These companies are spending $380 billion building capacity because demand is supposedly insatiable. But their cloud growth rates are 30%, not 300%. 30%. If demand was truly insatiable, growth would be accelerating, not holding steady. The spending is growing 4 times faster than the revenue. That's not a sustainable business. That's a bubble. What's actually happening in enterprises? Most companies are doing AI pilots, just testing things out. Very few are running AI in production at scale. The integration challenges are massive. The ROI is unclear. Executive teams are skeptical. Survey data backs this up. McKinsey found 80% of companies see no profit increase from AI. MIT found 95% of pilot projects fail. Gartner reports that AI projects are taking 2 to 3 times longer than expected to implement. The tech companies are betting on a massive adoption wave hitting in 2027 to 2029. They're building infrastructure now for demand they expect in 3 to 5 years. But what if that wave doesn't come? Or what if it comes much slower than expected? Then you have hundreds of billions of dollars in infrastructure sitting idle, depreciating in value, generating no return. And then there's the power problem, which nobody's talking about seriously enough. AI data centers require nuclear power plant levels of energy. The U.S. power grid is not ready for this. It takes 5 to 10 years to build new power plants. Regulatory approvals are slow, and there's massive NIMBYism in data center locations. One OpenAI data center requires 1 gigawatt of power. That's 1/3 of a nuclear power plant's output. They're planning 30 gigawatts of capacity. Where does that power come from? You can't just will electricity into existence. Physics doesn't care about your AI ambitions. Right now, the American power grid is not capable of supporting the AI infrastructure these companies are building, which means either the infrastructure sits idle waiting for power, or the promised AI revolution is physically constrained by the laws of thermodynamics. But let me give you the bull case because I want to be fair. The optimists might be right. AI actually works. ChatGPT is genuinely useful. GitHub Copilot demonstrably increases developer productivity by 30 to 40%. Enterprise customers are seeing real gains in specific use cases. This isn't vaporware like most .com products were. The internet eventually delivered on its promise. Yes, the .com bubble popped spectacularly, but Amazon, Google, and Microsoft not only survived, they thrived and became the most valuable companies in the world. The internet did transform everything: commerce, communication, entertainment, education. It just took longer than the bubble assumed. Maybe AI is the same. Maybe these companies are early but directionally correct. The hyperscalers can afford to wait. Microsoft, Google, Amazon, and Meta have strong free cash flow. They're not going bankrupt even if AI disappoints for the next 5 years. They can absorb losses and wait for monetization. Unlike .com companies that needed continuous funding to survive, these companies can play the long game. There are genuine winner-take-all dynamics in AI. More data leads to better models, which attracts more users, which generates more data. It's a flywheel. The early leaders like OpenAI, Anthropic, Google, and Microsoft may create moats that are impossible to breach. Being second in AI might mean being nowhere, just like being second in search meant nothing against Google. The productivity revolution is real, but every major technology platform took 10 to 15 years to mature. The PC revolution was an idea in the 1980s, but became reality in the 1990s. The internet was an idea in the 1990s, but became reality in the 2000s. Mobile was an idea in the 2000s, but became reality in the 2010s. Maybe AI is an idea in the 2020s that becomes reality in the 2030s. The companies spending today might look prescient in hindsight, and there's the regulatory moat argument. The incumbents have the resources to handle increasing regulation. Smaller players will be shut out by compliance costs. Regulation might actually increase Magnificent Seven dominance by raising barriers to entry. I'm being intellectually honest here. The bull case is genuinely compelling. AI is real. The technology works. These companies have the resources to play the long game. Maybe they're wrong about the timeline. Maybe it takes 10 years instead of 5. But if they're directionally correct, their current investments will look brilliant in 2035. But now let me give you the bear case, because this is where I think the weight of evidence lies. The spending exceeds revenue by 10 to 20 times. $400 billion in annual spending. The leading AI company makes $13 billion and loses $12 billion per quarter. The economics don't work even with aggressive growth assumptions. This reminds me of WeWork's growth at all costs mentality. That's not a sustainable business model. The monetization model is fundamentally broken. Users expect AI to be free because Google trained them for 20 years that search is free. Only 3 to 5% are willing to pay. Enterprise adoption is slow. You can't raise prices without losing users to free alternatives or open source models. The infrastructure is sitting idle. They're building capacity for demand that doesn't exist yet. This is dark fiber 2.0. The depreciation costs will eat into profits for years, and there's a massive opportunity cost of capital. That $400 billion could have been returned to shareholders, invested in proven businesses, or used for acquisitions. Even if AI succeeds, the margins will be terrible. Google Search operates at 60 to 70% operating margins. AI services will be lucky to hit 20 to 30% margins because they're compute intensive. So these companies are trading high margin businesses for low margin ones. That's a terrible strategic trade. Competition is going to drive prices towards zero. Open source models are improving rapidly. Meta's Llama, Mistral, and others are getting better. Chinese competition is fierce. DeepSeek trained a competitive model for $6 million. Model commoditization is happening faster than anyone expected. When you have no pricing power, you have no profits. Regulatory risk is mounting. Antitrust actions are already hitting Google with potential for more. The EU AI Act is imposing massive compliance costs. Data privacy regulations are limiting access to training data. Governments are starting to view this level of market concentration as a national security risk. Then there are physical constraints nobody's solving. Power limitations are real. Water for cooling is becoming scarce. Data centers use staggering amounts of water. Real estate for data centers in suitable locations is limited. They can't build fast enough even if the demand actually materializes. And historical precedent is undefeated. Every major infrastructure boom in history has overbuilt railroads, canals, fiber optic cables, broadband. Investors always assume this time is different. It never is. The pattern repeats with shocking regularity. Let me give you the specific risks by company. Nvidia derives 95% of revenue from AI chips. It's a single product line risk. They face competition from AMD and custom silicon from Google, Amazon, and Microsoft. China export restrictions have cut off a massive market. If AI spending slows even a little, Nvidia crashes first and crashes hardest. Microsoft is losing $12 billion per quarter on OpenAI. Azure growth is slowing from previous quarters. Office Copilot adoption is disappointing relative to expectations. The stock is priced for absolute perfection. Any disappointment triggers a major correction. Google's search business, which represents 60% of revenue, is under existential threat. They're playing catch-up in AI despite literally inventing the transformer architecture that makes modern AI possible. Gemini is behind ChatGPT in market perception. They're spending enormous sums to protect a declining business. Amazon's AWS is growing slower than Azure. Their retail margins are thin. That $125 billion in capital expenditures is compressing free cash flow dramatically. The stock price is entirely dependent on the AWS growth story continuing. Meta has no cloud business, which means no B2B revenue stream for AI. That $70 billion in spending is purely speculative. The metaverse write-down is still fresh in investors' memory. They've done this before, bet big on a future that didn't materialize. Investors are losing patience. Apple is late to AI. Their AI features aren't differentiated. Siri is still the worst voice assistant after all these years. They can't compete with OpenAI or Google on foundational models. They're the most vulnerable to disruption. Tesla's full self-driving is still not actually full self-driving. The robotaxi timeline keeps slipping year after year. EV competition is intensifying globally. The valuation assumes AI dominance in autonomous vehicles that simply isn't materializing. So what's my verdict? Are we in a bubble? Here's my honest assessment. Yes, we are in a bubble, but it's a different kind of bubble than most people think. This isn't the dot-com bubble where companies with no revenue and no business model traded at insane valuations based on pure speculation. This is an infrastructure bubble. Companies with real, profitable businesses are making massive bets on a future that might take much, much longer to arrive than they expect. Let me give you 3 scenarios with probability estimates. Scenario 1 is the soft landing, which I'd give about a 30% probability. In this scenario, AI adoption accelerates between 2026 and 2028. Enterprise monetization gets figured out. OpenAI actually reaches profitability by 2029 or 2030. The infrastructure gets used efficiently. Magnificent. 7 valuations get justified by actual earnings growth that materializes. You get returns, but probably not spectacular ones. Some companies like Microsoft and Nvidia do well. Others like Meta lag behind. It works out okay. Scenario 2 is the slow burn, which I think has about a 50% probability. AI adoption is significantly slower than expected. It takes until 2030 to 2035 for full monetization and mainstream adoption. The massive infrastructure sits largely idle for 5 or more years. Stocks go sideways or down for years. Some companies, particularly Meta, write down billions in AI investments. It eventually works out because the technology is real, but it's a long, painful wait. This scenario gives you negative to flat returns from 2025 to 2030, then recovery from 2030 to 2035. If you have a 10-year time horizon, you eventually make money, but you suffer for half that period. Scenario 3 is the hard crash, which I'd estimate at about 20% probability. There's a major trigger, either a recession, an interest rate shock, or an AI winter where the technology hits fundamental limitations. Spending cuts cascade through the entire industry. Nvidia's revenue collapses because they're the first domino. The Magnificent 7 concentration reverses violently. OpenAI and other AI startups fail outright. We see 50 to 70% drawdowns in technology stocks. This creates a generational buying opportunity for those with cash, but it's absolutely brutal for current holders. Here's my timeline for how this plays out. 2025 to 2026 is the spending peak. Infrastructure build-out continues at full speed. Valuations stay elevated because momentum carries markets, but revenue growth can't keep pace with spending. We start seeing more meta-style earnings shocks where companies miss expectations and stock prices gap down violently. 2027 to 2028 is the reckoning. Companies are forced to show return on investment. If AI monetization isn't working, spending must be cut. Some projects get written down. The market reassesses valuations across the board. This could be gradual, the slow burn scenario, or it could be sudden, the crash scenario. But the reckoning comes. 2029 to 2030 is the resolution. By this point, AI has either proven itself and the stocks recover strongly, or we see massive write-downs and complete reset of expectations. A new equilibrium gets established. One way or another, the bubble has popped by then, and we know what the new reality looks like. So what does this mean for your portfolio right now? If you own tech stocks, don't panic sell, but absolutely rebalance. If technology represents more than 40% of your portfolio, reduce it to 25 to 30%. Take some profits while valuations are elevated. Diversification is your best friend in what's coming. Within technology, be selective about what you hold. Lower risk positions are Microsoft, because they're the most diversified with strong existing businesses, and Apple, because the iPhone is still a massive cash cow. Medium risk is Google, because the search moat is still strong despite erosion, and Amazon, because AWS plus retail gives them multiple revenue streams. Higher risk is Meta, which is a pure AI bet with no B2B monetization, Nvidia, which is essentially a single product company, and Tesla, which is entirely hype dependent. The highest risk is pure AI plays. Holding those through to 2030 requires an iron stomach and the ability to withstand 70% drawdowns. There's a specific problem with S&P 500 index funds that most investors don't understand. When you buy the S&P 500 today, you're putting 37% of your money into 7 stocks. That's not diversification. That's concentration masquerading as diversification. Consider the equal weight S&P 500, ticker RSP, instead. Or there's actually a fund called XMAG. That's the S&P 500 excluding the Magnificent 7. Those give you actual diversification. If you're thinking about buying tech stocks now, wait for a pullback. A 10 to 20% correction is likely within the next 12 months. Don't chase momentum at all-time highs. Nvidia at a PE of 44, down from 78, might seem cheap. It's only cheap if the earnings growth actually materializes. If AI spending slows, that 44 PE becomes very expensive very quickly. There's actually a value play developing. The rest of the S&P 500, those 493 companies, are trading at about 20 times forward earnings. The Magnificent 7 are at 31 times forward earnings. That valuation spread will normalize eventually. Either the Magnificent 7 falls to meet the market, or the rest of the market rises to meet them. Historically, it's usually the expensive stocks that fall. And here's the contrarian play. If there's a crash, have cash ready. The best investment opportunities in history come immediately after bubbles pop. Amazon went from over $100 to $6 after the dot-com crash, then went to $3,000 over the next 2 decades. If you can identify the survivors, the companies with real businesses that can weather the storm, and buy them when everyone else is panicking, you can generate multi-decade, life-changing returns. Here's the big picture that every investor needs to understand. The question isn't whether AI will transform the world. It will. The question is whether the timeline and monetization assumptions built into today's stock prices are realistic. Based on the math I've shown you, $400 billion in annual spending, $13 billion in revenue from the leading company, $12 billion in quarterly losses from that same leading company, the answer is clearly no. Current valuations assume a perfect future that has never existed in technology history. They assume everything goes right, adoption happens fast, monetization gets figured out, competition doesn't drive prices down, regulation doesn't slow things down, and the infrastructure gets fully utilized. That's a lot of assumptions. Every transformative technology eventually delivers on its promise. The internet absolutely did transform everything, but it took 20 years, not 5. And investors who bought at the peak of the bubble in 2000 waited 15 years just to break even. The early internet companies, the Yahoos, the Pets.coms, the Webvans, they didn't survive to see that transformation. Only the companies with strong existing businesses and patient capital made it through to the other side. The Magnificent 7 have strong existing businesses. They generate real revenue and real profits. They can survive an AI winter, but that doesn't mean their stock prices can't fall 50% or more. It just means they'll eventually recover if you can hold for a decade. The question you have to ask yourself is, can you wait 10 years? Because that's what happened last time. Here's my advice, and I say this as someone deeply involved in AI development who understands both the technology and the markets. Be skeptical of the hype, but don't dismiss the technology. AI is real. It works. It will be transformative. But the timeline for monetization is being dramatically, perhaps catastrophically, underestimated. And the amount of money being spent assumes a level of adoption and willingness to pay that may take a decade to materialize, if it ever does. Let me give you 5 rules for navigating what's coming. First, diversify away from concentration. If tech is more than 40% of your portfolio, reduce it to 25 to 30%. The 37% concentration in the Magnificent 7 is dangerous and historically unprecedented. When it reverses, it will be violent. Second, distinguish between technology as a tool versus technology as speculation. Microsoft Office generates real revenue from real customers paying real money. That's technology as a tool. OpenAI's image generator is used by millions, but almost nobody pays. That's speculation. Favor companies with proven monetization models. Third, watch the free cash flow religiously. If capital expenditures exceed operating cash flow, that's a massive red flag. Meta is borderline right now. Watch them closely. Microsoft is still healthy, but the trajectory is concerning. Free cash flow is truth. Everything else is speculation. Fourth, have a long time horizon. If you're buying technology stocks now, assume a 10-year hold minimum. Anything less is speculation, not investing. Near-term volatility is absolutely guaranteed. You will see your positions down 30, 40, maybe 50% at some point. If that will make you sell in a panic, don't buy now. Fifth, keep powder dry. A 30 to 40% correction in technology stocks is coming. It's not a matter of if, it's a matter of when. The best buying opportunity of this decade will arrive when everyone else is panicking and selling. Be ready with cash to deploy when blood is in the streets. Here's the bottom line. We are living through one of the largest infrastructure buildouts in human history. $400 billion per year flowing into artificial intelligence. That's larger than the entire GDP of most countries, and it's all based on belief. Belief that AI will generate trillions in economic value over the next decade. That belief may be correct. Directionally, it probably is correct. But belief is not a business model. Revenue is a business model. Profits are a business model. And right now, in November 2025, the spending is racing ahead of revenue by 10 to 20 times. That is the textbook definition of a bubble. Will it pop? History says yes, emphatically yes. Every major infrastructure boom in recorded economic history has led to overcapacity and eventual correction. When will it pop? That's harder to say with precision. It could be 2028, but I would be genuinely shocked if we make it to 2030 without a significant, painful reset in technology valuations.